I know you're very sick of seeing me, but yeah, you're stuck with me. So, yay. Hey, everybody. Come on up, guys. So this is a panel I've been waiting for because it really gets to the heart of where the space overall is going. Everyone by this point has certainly heard the terminology RWA kind of bandied about, but I think it's a moniker for quite a few things, some of which are germane and some of which maybe will actually morph into other things. Let's do real quick intros of each one of us, not me, because you know me, but the rest of the panel, just so you know who we're speaking with.
Hi, I'm Sami. I'm the co-founder and CEO of Transak. I'm based here in Miami. Transak is a leading fiat on-ramp provider, which means that we provide integrations that allow users to convert between fiat, crypto, or crypto to fiat. That can include cryptos like ETH or BTC. It can also be stablecoins. And we power most of the major blockchain applications such as MetaMask, Trust Wallet, Coinbase, Binance, and many others. And we have more than 8 million registered users. We've raised funding from the likes of Consensus, Animal Brands, UOB Bank, and others. Great to be here.
I'm Sidney Powell. I'm actually originally from Australia, but I'm the CEO and co-founder of Maple Finance. You can think of us as an institutional lender, not too dissimilar to like a credit fund on chain. So we settle loans on chain using smart contracts. We typically take digital assets as collateral, but we've also done tokenized real-world assets as collateral as well. So we've been around about 3 years now. So we currently have about 570 mil assets on the platform, and since we started, we've done about 5.2 billion in loans. So very happy to be here.
Also, my name is Martin Carrica. I'm the founder and CEO of Mountain Protocol, originally from Argentina, live in Miami as well. And Mountain Protocol is a yield-bearing stablecoin. Think of it as USDC, but if you hold it on your wallet, you get 5% yield or something like that, like in treasuries. And essentially, it's about bringing capital efficiency into the ecosystem instead of moving on chain and kind of leaving your yield behind. So we can actually bring institutions on chain. We launched almost a year ago, and we have the likes of Arbitrum, Ethena, several other DAOs and so on holding USDM as part of their treasury and making moves into other places so more folks can access better assets. So excited to be here.
Great, and we're excited to have you. So the RWA space, if you look at it, like the total of the market opportunity is actually staggering. Like it's hard to honestly wrap your head around. And it's been getting a lot of attention recently. I'd love to get your thoughts on what you feel like are the major catalysts of the attention that it's now starting to get. And maybe that could be macroeconomic influences such as an inflationary environment, but I'd love to get like just kind of your view of the tea leaves right
now. Yeah, maybe I'll take it first. So I think tokenization is, if you transacted financially, like financial operations, when you do TradFi versus doing crypto, crypto is a lot better. And I think that's 100% in agreement with everyone who's done crypto. It's the same as moving from paper to electronic, right? So you had paper, then you had electronic. Today, we don't talk about electronic finance. We just talk about finance. But everything you do is electronic. I think the next one's going to be tokenization. So the market cap for this is like basically all of finance. Now, how do we get there? There's several areas where you can start first. So what are the first problems? The first obvious problem is people that don't have access to US dollars or have access to US dollars in cash because the government doesn't allow them to buy US dollars, or have to pay through SWIFT, which is very expensive, very slow. Stablecoins came in to solve that. Sami knows a lot of that. But stablecoins is the first kind of real-world asset. It's a dollar on chain. Then you have many other assets that you can bring on chain, namely kind of stocks, bonds, private credit. And I think the big catalyst of on-chain or the first buyers are people that are not well served today by the ecosystem. So if you think about concentric circles, in the middle you have like JP Morgan, BlackRock, like everyone that works like in those couple of blocks right in New York City. those guys are very well served by the current system. And if you go outside of those circles, you have like other people in the US, other people in developed markets, people in emerging, like big companies in emerging markets, and it can be retail emerging markets. This last circle is the first buyer of real assets. And they are the first buyer of stablecoins, and I think they're going to be the very first buyers of other assets. I think those people are starting to buy other assets. They participate in DeFi a lot to gain yield today. And if they have better assets, they will start moving into other places. And I would say the big catalyst for this is obviously regulation. Like, how do you bring people on chain if the Wall Street Journal talks about Tether getting OFAC sanctioned? I think that was 2 or 3 days ago. That like no normal person is going to put real money on something like this. That's the news that we're discussing. So very bullish with the election this week and having that clarity. Sorry for the long money.
Tether's money is all managed by Trump's new transition chair, Howard Lutnick.
Bullish.
He's got 130 billion of his deals under management. I think, if you look back like 2 years ago, I think the big macro catalyst was the shift up in rates. So that really pushed the purchases of tokenized T-bills through 2022, and it was a massive trend in 2023. I think what we're seeing now, the big catalyst is that rates are trending down again, is that's pushing people into other forms of tokenized assets outside of just tokenized T-bills. And then I think stablecoins, we've seen a huge emphasis on investment in that space. Revolut is launching a stablecoin. Ripple is launching a stablecoin. I think that is, that asset class is just going to continue to grow. It's like 150 plus billion at the moment. I think that'll get to $1 trillion in the next couple of years. But that then enables more tokenization of real assets, I think, because that's ultimately generally what you're using to purchase it. When I've talked about the type of lending that we do at Maple, it's all direct lending, but it's all done in stablecoins. So we really need that in order to be able to use tokenized assets and to tokenize assets. So I think that's the proliferation of stablecoins, rates environment, and inflation are probably some of the bigger drivers I'm seeing.
Okay, so the way that we think about market sizing for this is that in the future they won't call it RWAs and DeFi and Web2 finance apps. They'll just call them finance apps. And this technology will be a back-end technology that's used in that. So, like Martin said, the market size is basically the market size of finance, whether that's stocks or bonds or properties or alternative investments. And in terms of the serviceable, obtainable market that we're seeing right now, it's very much remittance, so retail remittance and B2B payments and invoicing. Now, retail remittance, that is sending money abroad to friends and family as an individual, is currently around 800 billion per year. Just overall Web 2, Web 3, everything like that. Ripple's doing a few billion of volume. So that's already starting to move on chain. And then B2B payments and invoicing, depending on how you define that, is at least an order of magnitude larger. And there's already companies who are moving hundreds of billions per year just internally with stablecoins. And the reason why I say that's serviceable, attainable is because we're doing a lot of deals in that space right now. We're helping a lot of people out with on and off ramps for remittance deals. And coming back to the point about not separating between Web 2 and Web 3, this could be Web 3 companies like wallets or companies that are especially in Web 3. But then there's also Web 2 companies who are starting to cross the chasm, and they're starting to use stablecoins in order to leverage their existing business operations. So I don't think any more of like the RWA market size. I just think of the finance market, and I think that we're disrupting the finance market.
And that sounds right to me as well. I believe that what's being built in the background, especially like if you look at JP Morgan Chase with Onyx, they are purposely doing that. All the while, their CEO was saying that Bitcoin and digital assets are trash, but he was privately hiring 4,000 cryptologists to build the world's largest blockchain infrastructure project ever. So, specific to RWA, I'd love to hear, like we talked about, I mean, T-bills are an obvious stablecoin, of course, but what are some of the more novel or innovative RWA plays that you're starting to see or have seen recently? We're talking about real estate. That's a natural use case, but I've seen tokenized vineyards recently. I've seen a number of different tokenized plays. So I'd love to hear a little bit more about that, like what you're seeing and out there in the space.
I think the most novel one that I saw in a recent period was tokenized Stradivarius violin. That was, I think it was the CEO of Animoca bought one in an auction, tokenized it, and then borrowed against it from Galaxy. So that kind of falls, in the space we're interested in, which is direct lending and private credit on chain. But I think the novel aspect there was that you tokenize something that's one of a kind and very rare and immensely valuable. But tokenized artwork is something we see more and more of. And there is actually a market lending against NFTs or tokenized collectibles. Much smaller and obviously quite volatile, but it's there and it's growing.
To me, it's similar to what Sid is doing, which is like crypto collateralized loans, but people bridging kind of the forex market. So say you have stable coins, you put that as collateral on an escrow in Argentina, where you wouldn't trust the banking system to do that. You wouldn't trust leaving it somewhere in the Argentinian law system. So you do it on chain, but then you use that as collateral to take a standard loan from a bank, right? So kind of this Web 2.5 bridging of using kind of real world assets to enable local finance using crypto. So you have a lot of that in emerging markets, people tapping on crypto assets and mostly stable coins, right? Like holding US dollars to tap into like Argentinian peso liquidity, Brazilian real liquidity, whatever that is. So very, very interesting.
Yeah. The other one that we saw was tokenized like small business or personal loans in emerging markets. I've seen fintechs in those countries look to borrow. We haven't done any of those deals just because it's still an emerging space. But I think it's important in those markets to get people access to finance and to credit so that they can transact or if they need to run a business to buy inventory, that type of thing.
Yeah, I mean, one that I'm excited about is you guys, the host of this conference, doing stable coins and properties on chain and doing the escrow with stable coins. I think just that whole money movement using stable coins, even though you're not necessarily putting the whole property on the blockchain or anything like that, I think it's a really great step in the right direction. And I think that mentality of not trying to like decentralize everything and just trying to be pragmatic and using blockchain where it makes sense is great. And so yeah, I'm pretty excited about that use case. I think that's pretty cool.
He wasn't paid to say that.
I wasn't paid to say that. I mean,
so one of the elephants in the room that probably, I mean, it's addressed, but I certainly want to bring it up is liquidity. Especially as you go into some of these more novel or nascent use cases, there's no liquidity there. And so what do you believe we can do from inside the industry to get folks from outside to start paying attention and participate in these markets? Because liquidity is the whole ball of wax ultimately. I mean, you can have a great asset that's worth $1 million, but if you don't have any liquidity there for someone to actually write that check to you, it's a problem.
True. Yeah, I tend to agree. I mean, ultimately, if there's not a liquid market for the asset, is it really worth what you think it's worth? And partially it's a function of the age of the market at the moment. So if you're around, it was only 2 years ago that a lot of pundits were calling the death of crypto post FTX. I think people have become a lot more comfortable holding crypto assets or tokenized assets, particularly with the likes of BlackRock moving into the space. I think there's definitely a trend where it's getting viewed as either safer and safer or more legitimate over time. But the more legitimate it seems in the eyes of investors, the the smaller the risk premium that you will ask for to hold an asset that is tokenized. Like currently, if I've got a REIT, maybe I want 5% yield if it's an off-chain asset, but I want a 7% yield if it's an on-chain asset. But that risk premium is going down over time as people get more comfortable, and that's what's required to get more liquidity in. I think at the moment, generally, when we talk to investors about tokenized assets, they really want to get paid for taking the risk of doing something on chain, and so I think that stops liquidity. But over time, that problem will solve itself.
Maybe from a different angle, but I think what we can do initially is today we have margin loans like Aave, Compound, called money markets, but I don't like that term very much. But basically, all of these protocols are working on Bitcoin, ETH, and stablecoins. And it's very hard for them to go to the long tail of assets because of the very high liquidity requirements and the very high decentralization bar that we're placing. Essentially, if there's going to be $100 million of borrow, there needs to be $100 million readily available on a DEX for liquidation. So the bar that we're placing on liquidity for something to live in DeFi is very, very high. I think what we can do, and hopefully someone can build in this space, is how do we put in Tesla stock? How do we put in NVIDIA? Like things that are very liquid in TradFi markets, how do we get them on chain and get them on chain integrating into these DeFi protocols and solve kind of the liquidation problem that you need? I think once we enable that, that learning on these like very liquid assets can allow us to continue to walk down the stair in terms of liquidity. But we haven't solved it for the most liquid assets off-chain. I think it's going to be very hard to solve it for unliquid assets off-chain and crypto all at the same time.
Yeah, I think we should not confuse the technology here with the business problem. So we should be conscious that blockchain is just a technology. It allows us to put this stuff on chain. It allows us to transact 24/7. It allows us to transact cross-border. But the underlying business problem doesn't really change. So like if you look at how fintech was 10, 15 years ago, you started to have private stocks that were going through like crowdfunding platforms. That was like a new development. And even today, the secondary markets for this kind of crowdfunding stocks are pretty sparse, right? It's hard to get liquidity on these kind of private stocks. Just because you tokenize a Stradivarius doesn't mean you're going to have liquidity on that. It's still like an extremely liquid asset. There's not going to be a lot of people who are going to want to buy that. So I think we should not confuse. We should not try to solve all of these problems together. We should just solve the technology problem and be happy that we solved that, and then that's a separate problem, in my opinion.
Well, I think of like the kind of the on-chain market as, it's kind of like how the internet was long tail for content. So if you publish some obscure piece of fiction, you were much more likely to find an audience. And so if you have an obscure asset, instead of only being able to sell it to people at a limited open outcry auction, you kind of have access to any potential buyer around the world. So I think that is like one way that you kind of unlock liquidity just by having an asset on chain or tokenized.
That's true. Yeah.
All right, I would love to get out our crystal ball and talk about what the next 5 to 10 years looks like. What industries do you think will start to embrace this space? And do you feel like this will end up ultimately being complementary? Or do you feel like this is really the evolution of a new asset class?
So I think step one is going to be retail remittance, B2B payments and invoicing. And I think especially like on the B2B side, the adoption is going to be huge because B2B is very rational. And if they can move money cheaper, faster, with instant settlement.
More securely.
And there's also a lot of interoperability there as well, where businesses can manage their back office using a lot of automations, right? If this, then that. So you can eliminate a lot of manual back-end operations work in a lot of companies. That's step one. I think we're still a long way out for a lot of this RWAs like stocks, bonds, like those kind of things. But we're talking with banks like JP Morgan, HSBC, Fidelity. They all have similar programs happening, which is all of these institutions, they have a custody branch. They also have a permissioned blockchain. Permissioned blockchain means you have to KYC. It's basically no better than, I used to think this was no better than just a centralized database. But then something I realized is that they're building all of this stuff on permissioned blockchains. And when the regulation comes into place, they can just flip a switch and they can start to make that permissionless. They can start to make it more decentralized, which is really, really cool. So I think that the security stuff, the other types of asset classes are going to take a lot longer, probably like 2 to 3 years. But when it happens, it's going to be really big and really cool. Yeah.
I'll talk about. So I think that I see the biggest impact is going to be on banking. So currently, even if you're not a bank but you do lending, you still send the money through the banking system. And I think it's going to be very different for the financial system when the money never actually goes through a bank. When we make a loan, we send the money directly to the borrower. And they receive it in a digital wallet. They don't receive it in a bank. And that money is backed by T-bills. So even the backing for it sits outside of the banking system. It kind of sits in the asset management space. And so I think that's going to be a huge unlock for alternative lenders. So our traditional competition is folks like Apollo, Ares, Blackstone, those type of players. But I think this is where you're going to see the most transformation because those guys are currently wedded to the banking system because anytime they give a loan, it still flows through the banking system. But using stablecoins and tokenizing the loans or tokenizing their fixed income portfolios is super different. And so I think you'll see the reach is much higher. The cost of operating one of those businesses is a lot lower. And so I think that's where you'll see the most disruption over probably not the next 1 to 2 years, but the next 5 to 10, I think will look very different.
Amen. I think we have 5,000 banks in the US. I think if we fast forward a couple of decades, that's going to be a way smaller number because you don't need to intermediate these payments. My bullish take, I think there's going to be $5 trillion in stablecoins in the next 5 years or so. Pending US regulation on stablecoins. But I think we're probably going to see that 2025. Every bank that at least I've talked to has a plan to issue a stablecoin. And my mom knows Bank of America. She doesn't know Circle. She doesn't know Tether. She doesn't know Mountain. But Bank of America is a very well-known brand. She probably trusts Bank of America more than she trusts her bank in Argentina. So I think a lot of people fall in that bag. And 5 trillion sounds like a very big number. When you look at like US dollar money supply, it's 25% of the money supply, but it's a very small number compared to $140 trillion of global M2. So the dollar today has 8% market share in international money supply. I think that number in international transactions is like 50 or more. In debt is like 70%. So the 8% looks like very low. And once you have stablecoins, you don't need to have intermediation through a bunch of local banks and so on to distribute these assets. So I think we're going to see $5 trillion in stablecoins, not one like Sid. So we'll see what happens. And I think that unlocks a ton of things. It unlocks his business. It unlocks a lot of synthetic real world assets. And I think that's the first thing we're going to see. If I'm a soy producer in Argentina, I might buy a futures contract on soy using a PERP platform. That is doable today. Once you get regulation, I think it's very likely you're going to see that before the real world assets kind of replace that and make it safer. So I think it's going to be a very, very interesting place and trend to watch. And yeah, we're going to start working again. It's going to start in Argentina. It's going to start in the edges, and it's going to start once that is said. It's going to start walking into the US and kind of the traditional financial system.
Your mom knows Bank of America, but doesn't know Circle. But I bet 20 years ago she knew GM and didn't know Tesla. And who would buy an electric vehicle off GM these days?
We'll see.
So just one more point that I'll add is a lot of the companies that we're working with at Transak right now who are doing real world assets, they're kind of doing it through a special purpose vehicle which is like a proxy to some other legal finality, right? So if it's a property, there's going to be some land registry, bonds, stocks, there's some kind of securitization that's happening. But, and that's happening right now to a smaller extent. Something that's going to be really cool is when you start getting legal finality and it's not a smart contract that's mapping onto a real world asset. The smart contract is the underlying asset itself.
The primary issue is on chain.
That's when the magic's going to start happening, and that's going to take time because regulations take time. No matter how many crazy tech people you have like trying to solve that problem, and when that starts happening, that's when the real magic's going to start happening. That's when the real interoperability, the whole ecosystem is going to start becoming much bigger.
Well, at least here in the U.S., it seems like there's a golden opportunity as we go into January 20th of next year for where we go from here. Let's give everyone the opportunity to say thank you for these gentlemen's knowledge. Great job.